Everyone thinks XRP already had its moment, that the run already happened, that the story is finished. But what if that belief is exactly why the real move hasn't even started yet? Markets don't reward the obvious. They reward what's misunderstood, ignored, and quietly built while everyone's distracted. And right now, XRP is sitting in that exact pocket, silent, underestimated, loaded. Ripple looks quiet on the surface, and that's what throws people off. No non-stop hype cycles, no meme frenzy, no endless interviews pumping price targets, just infrastructure, regulations, and positioning happening behind closed doors. And here's the uncomfortable truth most people don't want to hear. The biggest moves in history never start when everyone's excited. They start when things feel boring, frustrating, and slow. That's where we are right now. If you're serious about understanding what's actually happening instead of reacting late, I built the XRP Insiders Elite for moments exactly like this. It's where I break down positioning, timing, and real signals. If you want clarity while others stay confused, it's in the video description. Now let's get into why XRP's silence matters. For over a decade, Ripple has existed outside the public market's pricing machine. That's a massive detail that almost nobody talks about. Public markets price narratives, expectations, quarterly emotions. Ripple has never been subjected to that process. Instead, it's operated through private valuations, private funding rounds, strategic partnerships, and closed-door deals with banks, institutions, and governments. That means one thing. XRP has never been fully priced in the way Wall Street prices assets. People assume Ripple's success is already reflected in XRP's price, but that assumption is built on a misunderstanding. You can't price what you can't see. You can't model what isn't disclosed, and you can't properly value an ecosystem when the core company has never gone through public scrutiny. An IPO changes that overnight. When Ripple eventually goes public, Wall Street doesn't just look at the stock ticker. They tear everything apart. Revenue streams, cash flows, strategic holdings, subsidiaries, licensing deals, regulatory posture, and yes, exposure to XRP. Not from a speculative angle, but from a balance sheet and infrastructure perspective. That's when XRP stops being just another token in the eyes of traditional finance and starts being analyzed as a strategic asset tied to a real company with real influence. Here's where timing becomes everything. A lot of people assume delays mean uncertainty or weakness. But in capital markets, delays often mean control. You don't ring the bell during chaos. You ring it when regulations are clearer, liquidity conditions are improving, and institutions are ready to deploy capital with confidence. That's not fear. That's precision. Wall Street doesn't front-run what it doesn't fully understand. It waits for structure. It waits for clarity. It waits for paperwork, compliance, and regulatory alignment. Until then, price action stays muted. Liquidity builds quietly. Positions get accumulated slowly, not by retail chasing green candles, but by capital that moves early and exits late. That's why XRP feels like it's lagging while other assets pump. It's not lagging, it's loading. And this isn't just a narrative anymore. Even traditional analysts are starting to say the quiet part out loud. Once Ripple's valuation is clarified, significant gains are expected. That language matters. That's not social media hype, that's institutional framing. It implies cause and effect. Valuation clarity first. Price response second. Now let's talk about utility, because this is where the story shifts from speculative to structural. Most people still think of XRP as a payments coin. Fast transactions, cheap fees, cross-border transfers. That narrative isn't wrong, but it's outdated. The XRP ledger is moving beyond simple payments and into institutional-grade lending at the protocol level. Not chaotic DeFi experiments, not unsustainable yield farms, real lending, fixed terms, fixed rates, risk frameworks that institutions actually understand. This is a massive shift that almost no one is paying attention to. Institutions don't chase pumps, they chase yield, predictability, and compliance. They want systems that behave consistently under stress. Validate-governed lending with risk isolation isn't crypto cross-play. That's traditional finance logic being rebuilt on-chain. When validators approve these frameworks, XRP stops being categorized as a speculative asset and starts being treated as financial infrastructure. And when an asset changes categories, the market has to reprick it. This is where you start to see smart money behavior diverge from retail emotion. While the broader market bleeds and fear dominates headlines, capital is rotating quietly. XRP pulling in tens of millions in inflows, while Bitcoin and Ethereum see outflows, isn't random. Nobody accidentally allocates that kind of money. That's intentional positioning. Retail waits for confirmation. Institutions position before confirmation exists. Historically, XRP has always moved last in the cycle. Bitcoin goes first. Ethereum follows. Alts rotate, and then XRP absorbs liquidity from everything that already ran. But when that happens, it doesn't trickle in. It rushes. Because by the time XRP moves, there are fewer alternatives left that haven't already expanded. That's why its moves are sharp, violent, and emotionally disorienting for people who waited too long. Now layer that behavior on top of real adoption. On-demand liquidity has already processed over 15 billion in volume in a single year. APAC corridors are dominating. Dozens of active payment routes are live. And a significant portion of Ripple's partners are actually using XRP, not just testing messaging systems. That's the difference between theatre and infrastructure. Global payments is a market measured in the hundreds of trillions. XRP doesn't need to dominate it. It just needs to compound. Every new corridor, every incremental volume increase, every additional institution adds pressure to the same fixed supply asset. Infrastructure turns on quietly. Price reacts later. That's why tomorrow isn't about a single candle. It's about positioning before clarity hits. IPO pressure, institutional lending, smart money inflows, real payment volume, regulatory survival already checked off. These are the ingredients that precede repricing events, not follow them. Most people will only understand this after it's obvious, but by then the advantage is gone. The reason most people miss these moments is simple. They're trained to watch price, not structure. Price is loud. Structure is quiet. Price creates emotion. Structure creates inevitability. And right now, XRP is one of the few assets in the market where the structure is strengthening while the price stays restrained. That disconnect doesn't last forever. Let's zoom out and talk about regulation, because this is the part of the story that quietly removed the biggest risk without triggering a price explosion. For years, XRP lived under a legal cloud. That cloud wasn't just about Ripple. It was about whether institutions could safely touch the asset at all. Compliance departments don't speculate. If there's uncertainty, they walk away. That's exactly what happened. Liquidity stayed thin by design, not by accident. Now look at what's changed. The regulatory survival test has effectively been passed. XRP is one of the few large-cap digital assets with real legal clarity in the United States. That alone should have caused a massive repricing. But here's the twist. Regulatory clarity doesn't cause instant pumps. It causes delayed allocation. Institutions don't buy headlines. They adjust models, update mandates, and wait for liquidity windows. That process is slow, methodical, and invisible to the public. While retail was focused on short-term price frustration, infrastructure kept turning on. Payment rails expanded. Partnerships matured. Corridors that started as pilots turned into production systems. And most importantly, XRP kept being used. Usage is the one metric that doesn't lie over time. If you look at on-chain data, the majority of activity on the XRP ledger isn't speculative trading. It's payments. That's rare in crypto. Most chains are dominated by internal token transfers, arbitrage, and farming activity. XRP's activity profile looks more like a utility network than a casino. That matters because utility-driven volume behaves differently during market stress. It doesn't disappear overnight. This is why emerging markets play such a critical role in the XRP story. Adoption doesn't start in New York or London. It starts where the pain is highest. Cross-border payments, currency instability, remittance friction, places where the existing system doesn't work well. When countries begin providing legal clarity for crypto, it's not about speculation. It's about functionality. When nations with tens of millions of people legalize and integrate crypto, that's not a headline for price tomorrow. That's a foundation for volume over years. And volume is what ultimately forces repricing. Markets can ignore narratives. They can't ignore sustained flow. Now let's talk about the ETF angle, because this is where perception starts to shift. ETFs aren't about retail hype. They're about access. They allow capital that is structurally barred from buying spot crypto to gain exposure through familiar wrappers, pension funds, retirement accounts, institutional portfolios that require regulated vehicles. When ETFs begin to see consistent inflows during broader market weakness, that's a signal, not a coincidence. XRP-related products attracting capital while other assets bleed tells you something important. Allocation decisions are being made based on asymmetry, not momentum. Asymmetry is where downside feels limited relative to upside potential. That's exactly how institutions think. And this ties directly into what major asset managers have been openly signaling. When executives at firms managing trillions talk about digitizing traditional assets and migrating markets onto blockchain rails, they aren't speaking hypothetically. They're describing a transition process. Absorb first, integrate second, dominate last. That process requires infrastructure that can handle real volume, real compliance, and real settlement speed. This is where most crypto projects fail. They work in theory, but break at scale. XRP was built for scale from day one. That's not marketing. That's architectural reality. High throughput, low cost, predictable finality. Those features don't excite retail traders, but they are exactly what institutions care about. And here's the part that makes people uncomfortable. If crypto truly becomes embedded into the global financial system, not every asset survives. Many are redundant. Many are too slow, too expensive, or too unstable. The winners won't be decided by Twitter sentiment. They'll be decided by which rails can move value reliably under regulatory oversight. This is why XRP's quiet persistence matters more than short-term volatility. It keeps showing up. It keeps processing volume. It keeps expanding corridors. It keeps integrating with legacy systems instead of trying to burn them down. That's not revolutionary rhetoric, but it's how real systems replace old ones. Another misunderstood piece is supply dynamics. XRP doesn't need a narrative-driven supply shock. It needs functional demand. When XRP is used as a bridge asset, it doesn't sit idle, it cycles. The more volume flows through it, the more liquidity is required to support that flow. That creates a baseline demand that doesn't care about market mood. As institutional lending frameworks come online, that demand profile changes again. XRP stops being something you just move through and becomes something you hold to generate yield or facilitate credit. That's a fundamental shift. Assets that produce predictable returns get valued differently than assets that rely on speculation. This is why the market feels wrong right now. Fear is high, confidence is low, but positioning tells a different story. Quiet inflows, structural upgrades, regulatory alignment, expanding usage. These are the signals that appear before major repricing events, not after. Most people wait for price to tell them what to think. By the time price speaks loudly, the opportunity has already narrowed. The early phase always feels uncomfortable. It always feels slow. It always feels like nothing is happening. That's the price of being early. XRP's story has never been about winning a hype cycle. It's about surviving long enough to matter. And now for the first time, all the pieces are converging at once. Regulation, infrastructure, institutional interest, global adoption, lending, ETFs, public market exposure on the horizon. Nothing explodes at the exact moment it becomes inevitable. It explodes after inevitability is already locked in, and the market finally catches up. This is not financial advice. Here's the part most people struggle to accept. Markets don't move when information becomes available. They move when positioning becomes unavoidable. By the time clarity is obvious, the asymmetry is gone. That's why the final phase before a major repricing always feels quiet, tense, and frustrating. XRP is sitting squarely in that phase right now. Think about how narratives usually flip. First, an asset is ignored, then it's mocked, then it's questioned, then suddenly it's obvious, and everyone claims they saw it coming. XRP has lived through every one of those stages, but what makes this moment different is that the excuses are running out. It's no longer what if regulation kills it. That didn't happen. It's no longer what if banks don't use it. They already are. It's no longer what if it's just hype. The data says otherwise. What remains now isn't uncertainty. It's disbelief. And disbelief is the final emotional barrier before repricing. The market is still anchored to old reference points. People remember the past cycles, the lawsuits, the missed expectations, the long stretches of sideways action. Anchoring bias is powerful. It convinces people that tomorrow must look like yesterday. But infrastructure assets don't behave like memes or startups. They behave like systems, slowly at first, then all at once. What's happening beneath the surface is a migration of trust away from fragile speculative constructs and toward rails that can actually move value under pressure. That's not something you see in a one-day candle. It shows up in corridors staying active during downturns, in institutions allocating during fear, in governments choosing clarity instead of prohibition, in asset managers preparing products years ahead of demand. This is also why volatility compression matters. Long periods of suppressed volatility don't mean an asset is dead. They mean energy is being stored. When volatility returns after compression, it doesn't ask permission. It expands rapidly because positioning is lopsided. Too many people on the sidelines. Too few willing to sell at old prices. XRP's liquidity profile is uniquely sensitive to that dynamic. When flows increase, they don't disperse across dozens of alternatives. They converge. That's what makes XRP's historical moves look irrational in hindsight. They aren't irrational. They are structural releases of pent-up demand. Another piece people underestimate is narrative fatigue. The market is tired of stories that promise disruption but deliver friction. It's tired of ecosystems that can't scale, can't comply, and can't integrate with the real world. As that fatigue grows, attention shifts toward assets that don't need explaining anymore, assets that just work. XRP doesn't need a new story. It needs the old one to finish unfolding. Payments are still the largest use case in finance. Cross-border friction still costs billions. Settlement delays still exist. Liquidity mismatches still cause instability. None of that has been solved by speculation. It gets solved by plumbing. XRP is plumbing. And plumbing is invisible until it fails or replaces something that did. The transition phase is always subtle. Legacy systems don't collapse overnight. They get patched, integrated, and slowly phased out. Crypto doesn't overthrow finance. It absorbs it. That's what executives mean when they talk about digitizing assets and moving markets on chain. It's not rebellion, it's migration. This is why the question isn't, will XRP move? The question is, when does the market finally accept what's already in place? And acceptance usually arrives suddenly, triggered by something that feels small at the time. A filing, a launch, a policy shift, a liquidity event. By the time the cause is debated, the effect is already underway. Tomorrow doesn't need to be dramatic to matter. Reset points rarely announce themselves. They're only obvious in retrospect. What feels like just another day often ends up being the day positioning quietly flips, the day weak hands finish exiting, the day patient capital finishes accumulating. And here's the hard truth. Most people won't believe this until price forces them to. They'll wait for confirmation. They'll wait for headlines. They'll wait for social proof. But confirmation is expensive. Social proof comes late, and headlines are written after the move. The people who benefit most from these moments aren't the ones who predict exact dates or candles. They're the ones who understand structure well enough to stay positioned through boredom, doubt, and noise. That's always been the real edge. XRP doesn't need perfection. It doesn't need to win every narrative. It just needs to keep doing what it's doing while the world slowly catches up. And that's exactly what's happening. If this feels uncomfortable, that's the point. Opportunity rarely feels good in the moment. It feels lonely. It feels uncertain. It feels like you might be wrong. But when structure, regulation, adoption, and capital all start aligning at once, discomfort is often the signal, not the warning. This isn't about predicting a top or calling a bottom. It's about recognizing when an asset has quietly crossed from speculative debate into structural relevance. Once that line is crossed, price becomes a matter of timing, not possibility. And timing, as always, favours those who are already there. If you want deeper clarity on positioning as this plays out, that's exactly why I built the XRP Insiders Elite. Real analysis and strategy, while others stay reactive.